Silver already printed the 100 headline in one market, while the US price is still acting like that move didn't happen. And the people who want you calm right now are leaning on the same trick they always use. That doesn't T count. It's just FX. It's just taxes. It's just local noise. Except there's a part of this setup that isn't emotional, isn't political, and isn't even negotiable. It's market structure. And if that part keeps tightening, the US price doesn't get a vote. By the end of this, you'll have a clean near-term checklist for the next week or two, the levels that actually matter, and the one hidden signal that tells you whether this is just a spike or the start of a reprice the paper market can't smoothly control. First, let's get brutally clear about what $100 silver happened there even means, because half the internet is arguing using different definitions and pretending it's the same conversation. When most mainstream people quote silver, they mean a liquid USD benchmark, spot, futures, a front-month reference. It's clean, it's standardized, it updates every second, and it's designed for paper. But when people there say silver is at a certain level, they're often talking about the real-world price, local currency, local taxes, local fabrication premiums, and the cost of actually acquiring metal that can't be conjured by rolling a contract. That's not a vibe. That's the all-in cost of ownership. So yes, $100 can happen in a place like India without COMEX printing $100. Because the local currency price can surge, premiums can blow out, and the distribution chain can get stressed. And here's the part that matters. When that happens, it's a warning light. Not a guarantee, a warning light. Because it tells you something about demand behavior, currency pressure, and physical friction that the clean USD screen can hide for longer than you'd think. But not forever, and that's where the real pressure starts. Now let's talk about what right now looks like on the tape, because this is not a sleepy metals market. This month alone, silver has moved like a liquidity event, not like a slow macro grind. It didn't politely climb, it jumped. Early January prints were down in the low 70s, and within weeks we're staring at the 90s. That's not normal, investors gradually reallocating. That's the footprint of a market that ran out of sellers at key levels, where every dip got bought harder than the last, and where shorts, whether speculative or hedging, had to respect that the old playbook wasn't working. But that's not the part that matters, because price can spike for a dozen reasons. The question is whether it can stay elevated long enough to change behavior, whether it forces participants to do things they don't want to do, whether it forces metal to move, whether it forces hedges to get adjusted, whether it forces inventory decisions. And the moment you start thinking in those terms, $100 there stops being a meme and becomes a mechanism. Let's bring that there into focus. In India, silver has been printing eye-catching local milestones, levels that, when you translate them back into ounces and dollars, make people throw around the 100 number. The headlines matter less than the behavior behind them, rapid moves, heavy interest, and the kind of buying that shows up when people don't trust paper promises as much as they trust objects. And no, that doesn't automatically mean the US price must match it tick for tick. But it does mean we're watching two layers of the same market, the financial layer and the physical layer. Most people only stare at one, and that's how they get blindsided. So here's the core conflict. The US benchmark price is the billboard, but the physical layer is the supply chain. If the supply chain starts vetoing the billboard through premiums, delays, pull forward demand, tightness in deliverable categories, then the billboard eventually has to catch up. Not because anyone is manipulating anything, but because incentives and constraints force convergence. And the hidden detail is how you can tell whether that convergence pressure is building or fading. The hidden detail is the structure underneath price, the spread, the curve, the calendar. Because the curve is where stress can't hide. Let me make this simple without making it dumb. Futures prices aren't just one number, they're a strip of prices across time. If the market is relaxed and metal is plentiful right now and financing is normal, the usual state for many commodities is that future months can be priced a bit higher than spot because of storage insurance and the cost of money. That's contango. It's the market saying, I'm not desperate for metal today, I can wait. Backwardation is different. Backwardation is when near-term prices get pushed above later prices. It's the market saying, I want it now. The near-term unit is more valuable than the later unit. In industrial commodities, backwardation can happen when there's a real shortage in the prompt window. In a monetary-ish metal like silver, part industrial, part monetary, backwardation is a flare. It's not a conspiracy. It's a signal. It can mean immediate supply is tight or demand is urgent or both. And when that starts showing up alongside loud local premiums, that S when you stop treating all $100 there as a trivia fact and start treating it as a symptom. Because if the front end of the curve starts screaming, it creates pressure in the paper system. Shorts can roll, yes. But rolling isn't free when the curve is stressed. People can source metal, yes. But sourcing isn't instant when supply chains and refining pipelines have lead times. That's the trap. That's the part most casual commentary misses. And if you're watching for one thing that flips the whole setup, it's this. Does the curve calm down or does it get more inverted? Because if it gets more inverted, the math changes. Now zoom in on the physical versus paper piece, because this is where trust gets won or lost. The futures market is brilliant at price discovery when liquidity is deep and delivery is credible. It is also brilliant at letting huge exposure trade without the metal moving at all, because most contracts are offset, rolled, or cash settled in practice. That's not a moral judgment. That's just how it works. But when a large group of participants suddenly wants the same thing at the same time, actual metal, prompt delivery, secured supply, the paper market can wobble, not collapse, wobble. Because the paper market is designed for netting and rolling, not for everyone to stand for delivery all at once. And that's where inventory language matters. People love to say, there's plenty of silver in the world. Sure, there's also plenty of oil in the world. Yet prompt oil can still spike if inventories and logistics get pinched. In silver, available and deliverable aren't synonyms. Metal can exist in forms that aren't immediately deliverable into the contracts that set the benchmark. It can be in the wrong place, the wrong bar size, the wrong legal category, the wrong owner's hands, or it can be allocated for industrial use. So when you're thinking about squeeze risk or sustained repricing, you don't just ask, does silver exist? Or you ask, can it show up where the benchmark needs it, on the calendar the market is demanding it? That difference is where squeezes are born. But that's not the part that matters. The part that matters is what it forces people to do. If prompt tightness appears, it forces fabricators and industrial buyers to pull forward orders. It forces dealers to manage inventory more defensively. It forces hedgers to rethink how aggressive they can be selling forward. It forces funds to respect that volatility can become one way, and it forces the short side to pay attention to the curve because their time advantage gets taxed. Now, why is this flaring right now, not 6 months ago? 2 reasons. Calendar and catalyst. The calendar is the quiet hammer in markets. We're in late January. Liquidity is thinner than people admit. Positioning has been relayed after year end, and the market is staring at known event windows that can reprice the dollar, rates, and risk appetite quickly. On top of that, there's been a geopolitical and trade policy vibe that is not calming down. The mere credible threat of new tariffs can push money into hard assets and simultaneously mess with supply chains and cost expectations. And if you don't think headline risk matters, remember, it doesn't matter because the headline is true. It matters because the headline changes behavior. Hedging, procurement, inventory. And when behavior changes, price follows. Here's one clean, real near-term calendar trigger you can pin to your wall. The Fed's late January meeting window. Markets front-run that. They hedge into it. They take risk off and on around it. And silver right now is trading like it's sensitive to those crosswinds, rates expectations, dollar swings, and the general do we trust paper mood. Add to that the month-end effect, funds rebalancing, risk managers tightening limits, margin departments updating haircuts, and you get a setup where a violent move can feed itself for days, not months, days. And those days can print levels that look impossible a week earlier. The next detail is what flips the whole setup. Options and gamma. You don't need to be an options quant to understand this. You just need to understand that dealers who sell options often hedge their risk by trading the underlying. When price approaches popular strikes, especially big round numbers, dealer hedging can create a feedback loop. If the market is moving up and dealers are short calls, they may have to buy as price rises to stay hedged. That buying can push price higher, which forces more hedging, which pushes price higher. That's reflexivity. That's gamma. It doesn't create the underlying demand from nothing, but it can turbocharge a move that already has a structural foundation. And in a market that has already jumped from the low 70s to the 90s within weeks, you don't ignore turbochargers. But here's the discipline. Gamma can amplify both directions. When the move reverses, hedging flows can flip and become selling. That's why people get emotionally destroyed in volatile metals. They think the thesis protects them from being shaken out. It doesn't. The market can be bullish and still whip your face off twice in a week. That's not a contradiction. That's the nature of a tight, leveraged, globally traded market where different participants have different time horizons and different constraints. And volatility is how the market checks who actually deserves to hold the position. That's where the real pressure starts. Now let's stack the evidence properly, because you don't build trust with one shiny argument. You build trust with layers that all point in the same direction. Layer 1, the sheer speed of the move. A market that can climb that far, that fast, is telling you liquidity is not as deep as it looks, or that buying urgency is overpowering normal supply. When sellers step away, price gaps. And gaps change psychology. That's the line the market can't unsee. Layer 2, local currency price explosions and retail attention. When local prices punch new milestones, it's often because demand is not just investment flows into ETFs, it's also household, jewelry, and small bar behavior, plus industrial stocking. That matters because it's sticky. People buy physical differently than they buy an app. Layer 3, trade and supply chain stress. When tariff threats heat up, procurement teams don't debate philosophy, they protect continuity. They pull forward, they overbuy, they lock in supply. And silver sits inside a lot of critical industrial use. Electronics, solar, specialized alloys, where we'll just wait for price to come down, is not always an option if you were trying to keep a factory line moving. Even if the headlines exaggerate, the defensive behavior can be real. But that's not the part that matters. Layer 4, the curve and spreads. When the near-term cost of metal rises relative to later months, it is the market's way of rationing today. It's saying, if you want it now, pay up. That's how markets solve immediate scarcity without needing anyone to declare a shortage. And if that curve stays tight, it can pressure shorts and encourage hoarding behavior, which further tightens available supply. Reflexivity again, but now anchored in physical timing. Layer 5, the byproduct nature of supply. A meaningful chunk of silver supply is produced as a byproduct of base metal mining. That means you don't just turn on silver production because price is up. If copper, lead, zinc mining isn't expanding at the same pace, silver supply doesn't magically flood in next month. Recycling helps, but recycling responds with lag, and only to the extent material is available and economic to process. And refining and logistics are real choke points. Bars don't teleport. Assay, transport, insurance, and inventory financing all matter. This is where macro meets metal. Layer 6, cross-asset behavior. When you see gold and silver both printing highs alongside equity volatility and policy uncertainty, you're watching a classic hard asset bid environment. Not always, not guaranteed. But you're seeing it now. It's not just one story, it's multiple stories converging. And that's why the move has teeth. Now, with that stack, let's answer the actual title question. Could $100 happen here next? Yes. Mechanically, it's possible. And more importantly, the path to it is not mystical. It's a sequence of constraints and incentives. Here's how it happens in plain sequence. Step 1. Price keeps holding higher lows, meaning dips get bought and sellers don't regain control. Step 2. The curve stays tight or tightens, meaning prompt demand doesn't fade. Step 3. Volatility rises, which forces risk managers and shorts to reduce exposure at exactly the wrong time. Step 4. Any catalyst, Fed surprise, tariff escalation, geopolitical flare, dollar wobble, pushes a thin order book through a key level. Step 5. Options hedging becomes a tailwind, not just a sideshow. Step 6. Local premiums widen, pulling metal toward the highest all-in bid regions, which tightens supply in other areas and feeds the perception that metal is disappearing. That perception doesn't need to be perfectly true to move price. It just needs to be credible enough to change behavior. And that's where the real pressure starts, when behavior changes before the data looks perfect. But I'm not going to sell you a one-way story, because this is silver. Silver is the most emotionally abusive metal in the mainstream imagination, and it earns that reputation by punishing people who confuse conviction with timing. So let's do the credibility move. The counterpoints cleanly, without fear. Counterpoint 1, demand destruction. Silver is not purely a monetary metal. If global growth suddenly rolls over, industrial demand can soften and silver can get hit. Even in a bull regime that can create drawdowns that feel like the end of the world. Counterpoint 2, the dollar and rates. If the Fed signals tighter conditions than markets expect, or if inflation fears fade sharply, real rates can rise and the dollar can strengthen. That can pressure metals quickly. You can be right long-term and still eat a brutal retrace short-term. Counterpoint 3, supply response at the margin. Higher prices can bring scrap out of hiding, encourage substitution at the edge, and motivate inventory holders to monetize. It doesn't fix structural tightness overnight, but it can cool a hot market. Counterpoint 4, margin and forced liquidation. This is the big one. When volatility rises, margin requirements can rise. When margin rises, leveraged longs sometimes sell just to meet calls. That selling can smack price even if the underlying fundamental story is intact. This is how markets cleanse positioning. It feels unfair. It's just mechanics. And counterpoint 5, narrative whiplash. The same media that ignored the move will suddenly cover it at the top, and the same crowd that mocked it will suddenly chase it, and that's when risk goes up. The market punishes late certainty. It rewards early patience. That's not a slogan. That's how you survive. But that's not the part that matters. The part that matters is what you watch next, because watching the right things turns noise into signal. So let's get concrete. Here is a 2-scenario lens for the next week or two that keeps you finance credible and emotionally protected. Scenario 1 is the controlled pullback and retest. price is extended. Even in a strong bull, markets breathe. In this scenario, silver pulls back into a prior breakout zone. Think the mid to high 80s area as the first meaningful retest region, with around 80 acting as a bigger psychological and structural line if volatility gets nasty. In a healthy retest, you don't see spreads collapsing into comfortable contango. You don't see local premiums evaporate overnight, and you don't see buyers completely vanish. You see buyers defend, you see dips bought, you see time get spent, not just price dropping. And you see the market build a base that can launch the next leg. That's the adult bullish scenario. It's less exciting, more sustainable, and it tends to trap impatient traders on both sides. Scenario 2 is the continuation squeeze and gap risk. This is the no time to breathe path. In this scenario, silver holds the 90s, presses toward the mid-90s highs, and then something breaks. Liquidity thins, a catalyst hits, and the market gaps into the kind of price discovery you usually only see when positioning is wrong-footed. This is where $100 here becomes a live possibility quickly. Not because $100 is magical, but because round numbers attract flows, hedging, and headlines all at once. And in a squeeze, those things don't arrive politely. They arrive in a rush. But here's the catch. This scenario comes with the nastiest whip risks. The same gap up that thrills people can be followed by a gap down that erases weeks and hours. That's how silver teaches humility. Now the key question, what confirms which scenario you're in? Confirmation for scenario 1, the controlled pullback. Price dips, but doesn't lose the 80 handle with authority, rebounds on high participation, and the market doesn't show panic behavior in the curve. You'll see the tape stabilize. You'll see sell the rip stop working. And you'll see buyers step in before the market gets desperate. Confirmation for scenario 2, the squeeze continuation. The market stays bid into event windows, holds above the low 90s on dips, and pushes through the prior highs in the mid 90s with a sense of urgency. Fast candles, shallow pullbacks, and a curve that doesn't relax. If you see local pricing staying elevated and any sign of prompt tightness, that supports the idea that the move isn't just paper froth. Now, what invalidates the bullish thesis in the near term? Not a red day and not a scary headline. Near-term invalidation is structural. It looks like this. A hard break below the major support zone. Think around 80 as the line in the sand for a lot of participants, combined with a calming of the curve easing of physical stress and a broader macro pivot that makes holding metals less attractive. That combination says the market tried to reprice and it failed for now. If that happens, you don't need to be devastated. You just need to be honest. Markets don't owe you a straight line. And now, the next week checklist, not 10 things. 3. 1. Watch the curve and the prompt premiums. You don't need to stare at every tick. Just ask, is the market paying up for now, or is it getting comfortable again? Comfort is the enemy of squeezes. 2. Watch the policy calendar and the dollar reaction. Into the Fed window, pay attention to whether the dollar strengthens on hawkish vibes, or whether risk-off pushes hard assets higher anyway. That divergence matters. If silver can stay strong even when the dollar firms, that's a statement. And that's where the real pressure starts. 3. Watch the big, round number behavior. How does silver behave when it approaches the prior highs in the mid-90s? Does it stall and bleed, or does it punch through like the market is underhedged? If it punches through, the next psychological magnet is obvious, and the market knows it. But the key is how it behaves on the first rejection. Because the first rejection is where weak hands get rinsed and strong hands decide if they really in. Now let's talk about you, the viewer, and the psychology trap that ruins good theses. Because even if you get the macro right, even if you get the metal right, you can still lose by letting volatility manipulate your decision-making. This is how it works. The market uses speed as a weapon. A fast drop makes your brain scream, I'm late, I'm wrong, get out. A fast spike makes your brain scream, I'm missing it, I'm late, get in. Both impulses are the same weakness, reacting to intensity instead of structure. And silver is a master at turning intensity into bad decisions. The defense is not be fearless. The defense is rules, time horizon, and distinguishing signal from noise. Signal is higher highs, higher lows, support levels holding, curve stress persisting, physical premiums not collapsing, and catalysts that keep behavior defensive. Noise is one ugly candle, one scary tweet, one sensational headline, one day where everything sells. Noise is the market's way of testing who is overleveraged and who is emotionally fragile. If you let noise set your actions, you become the liquidity for someone who planned better than you. So here's a simple shield you can actually use. Before you let a price move change your position, ask one question. Did the structure break, or did the market just get loud? All this. If the structure didn't break, key levels intact, curve not relaxing, the tape not capitulating, then a violent move is often a shakeout, not a reversal. And if the structure did break, then you don't need to argue with the market. You step back. You reassess. You keep your capital for the next clean setup. That's how you stay alive in metals. Now, bring it back to the title one more time. $100 silver happened there. Could it hit here next? Why? The why is not a single villain or a single narrative. It's a chain. Local price stress revealing physical friction, macro uncertainty pushing hard asset bids, supply that can't instantly respond, and a paper market structure that can amplify moves when positioning is wrong and liquidity thins. The hidden detail is the curve, because the curve tells you whether the market is desperate for now. And if the market is desperate for now while the world is getting more uncertain, the number on the screen can move faster than your disbelief. Because if this one level breaks, the math changes. If you're the kind of person who wants to be early, not loud, this is the moment to stop arguing online about whether it counts and start watching the signals that actually force behavior. Watch the curve, watch the key levels, watch the calendar, and watch how quickly the market forgives dips. Silver doesn't need everyone to believe. It just needs enough participants to be forced into the same direction at the same time. That's when it gets cinematic. And here's the quiet community call. Because this isn't about hype. If you're building a process, levels, structure, curve, calendar, stick around with the people who think in checklists instead of vibes. That identity matters, because the next 2 weeks could reward discipline more than brilliance. And if we do get the push toward that obvious magnet, I want you watching the same 3 signals with me, not chasing the same headline with the crowd. Price can whip around violently, even if the thesis is correct. That's not a warning to scare you. It's a reminder to keep your plan bigger than your emotions. Controlled pullback and retest, or continuation squeeze and gap risk, those are the 2 clean paths. Your job is not to predict perfectly. Your job is to recognize which path is unfolding and act like a grown-up about risk. Because silver doesn't just move, it tests. And the test is happening right now.